everybody feeling so far? Everybody feeling okay? Is there anything that you feel like went over your head, you don't understand? Okay with the basic concepts so far? We call them basic. How about let's remove the word basic concepts? Some aren't basic, but okay. All right, good. All right. So what we're going to need to do now is pull out that trading multiples file. Trading comps should look like this. Yep, I got to go back to Zoom, share this. So the file you should have open should look like this. Yep. Okay. Okay. So this is what this means. I'm sorry. This is what we're going to use. I am a little tired. I drove to Philadelphia last night to Jersey at like midnight, so I worked late. And so if I say something that doesn't make sense, just catch me. I'll be like, "Hey, what are you saying? You know, you gotta keep me honest here." This is typically how a multiple sheet looks. Generally, everybody's got their own way, a different format, but you know, you have kind of sales on top, gross profit, income, EBITDA, earnings per share, and there's some more statistics. Simple things you want to know day one of a job, right? What are these terms like, you know, LFY, CFY, NFY, LTM? LFY is last fiscal year. CFY, current fiscal year. NFY, next fiscal year. LTM, last 12 months. So, quick test. We're in 2021 fiscal year. What's the current fiscal year? 2021 is the current fiscal year. What's the last fiscal year? What's the next fiscal year? If I'm in September of 2021, what's the last 12 months? Where did we start from? September 2021, we're going to go backwards to, so that is technically last month, but you're going to start from October, right? So October, November, December, January, February, March, April, May, June, July, August, September. Gives you 12 months, right, of performance, okay? The last 12 months of performance. You don't want to catch that the same month period because then it's 13 months, right? You're counting the same month twice, right? Because September, you're counting it twice. So everybody clear? So if I say June is today, what would be the last 12 months? What would be all the months you have to include? Don't give me them all. What? From July of 20 to June. Right. If I said April 2019, where are you starting from? Exactly. Okay, get it? Why would you do that? Why is that important to know? Yeah. Trends are important. How are we performing right now? Right, but what about just, you know, if I told you that, let's say it's September 2021, and I told you, you want to buy my company. You say, yeah, I want to buy your company. Okay, so I gave you December 2020. So you got January to December. But now we're in September of 2021. 9 months went by. Aren't you going to want to know what I did for 9 months? What did I this year? I said, oh, just look at that year. Look at the last year. So you're going to know trends. How are we looking the last 12 months? How are things moving? And as you said, trends are important. LTM last 12 months, and we talked about this. EBITDA, earnings per share. Operating cash flow, capital expenditures, free cash flow. Okay. You see this? This is this minus that, right? C22 minus C23. Operating cash flow does not include capital expenditures. A general terminology is operating cash flow minus capital expenditures equal free cash flow. All right? You have debt and cash. Net debt. If I told you that a company has $100 million of debt and $50 million of cash, what would be the net debt? What would be the net debt position of the company? 100 million of debt, 50 million of cash. 50. It's just the difference between the two, right? Why is this important? Because you want to know what if the company had to take all their cash and pay down their debt? Can they do that? Or can't they do that? It doesn't necessarily mean you need enough cash to pay down your debt. That's not what you're trying to accomplish here. We're just trying to get understanding what's the net debt. Net debt is actually in the calculation of enterprise value. When we think about equity, market cap plus net debt, because the cash in an acquisition, typically they'll use the cash to pay down the debt to kind of get our balance sheet clean if we have to. An acquirer, when I buy your business, I'm buying the cash too. I'm buying everything in your business. I'm buying your debt. I'm buying your cash. I'm buying your equity. So you can use, if I buy your business, I can take the cash you have in the bank and pay down part of your debt on top of refinancing your debt. Does that make sense, everybody? Net debt confuses people when it comes to enterprise value. It's just a conceptual thought. The cash would be net of the debt. You could take the cash and pay down the debt. All right. So what I want to do is look at these things, come up with our calculations. What does growth look like? What are multiples and what's risk? When we think about net debt to EBITDA, cash interest coverage, free cash flow to total debt. Cash interest coverage is just EBITDA over interest expense. How much annual EBITDA do we generate to pay our annual interest? Does that make sense to you guys? Why it would be important? If I told you that we're going to do this, more risky, less risky thing. If I told you that a company had, now remember, EBITDA over interest is cash interest. If I told you that one company has 5 times cash interest coverage and one company has 1 time cash interest coverage, which one is more risky? Which one is more risky? Yes. That's what I asked, right? Okay. 1 time. You're right. I just lost my own train of thought. You know why? Because you weren't like confident like 1 time, so you made me think, well, what did I ask? All right, yeah, so 1 time. Confidence is key too, by the way, even if you're wrong. Just 1 time. All right, so that was good. 1 time is more risky. Why? Because your earnings you have 1 year of earnings to cover 1 year of interest. What happens if earnings go down 20%? Your interest doesn't change, right? It's contractual obligation. You owe me interest payment. So what is that? What happens if you go down 20%? Let's say 100 million of earnings or EBITDA, interest 100, right? All right, sorry. Just got to get the, okay. So it's 1 time, right? What happens now? This declines, right? If something goes from 100 to 80, it goes down 20%, right? What happened to our cash interest coverage? It went down, right? So what is that telling you? What's the 0.8 tell you? Don't let me down. Come on. I'm just kidding. Well, what's the 0.8? 0.8 times coverage. It is. So now, are you able to make your full interest payment? You're not, right? So you see why this is more risky, right? Does everybody see that? Why this is more risky? How about this? You see how that's less risky? Right? We had the same 20% decline, right? Everything went down 20%, but are we still paying our interest? We are. Okay. So, excellent. That's all we're trying to get with that concept. And I you see, like concepts. I'm the concept master. Big fan of concepts because I feel like everybody blows by concepts too fast. Everybody just and everybody gets right into numbers. And sometimes you just got to understand, what are we doing? What's the purpose of why we're talking about these things? So what was the login password? Same thing? All right, this computer sounds like it's going to take off. All right. I haven't used, I never use Bloomberg and FYI, so I use a different software, but CapIQ is what we use. See if I remember this. Oh, okay, you're right. So let's go back quickly. So we have our trading comes with Macy's, JWN is Nordstrom, BBY is Best Buy, TGT, and WMT. Look at him, Jim Cramer over there. All right. So let's start with Macy's. I think I have my Bloomberg certification from this room, so some things you remember. Okay, so what I want you to do now, simple things in financial life. Numbers going from left to right in an ascending to descending or future time frame to an older time frame, no good. We need to reverse this. All statements, all financial statements, when you put them into an Excel model, you go from old to new, from yesterday to today to future. Always, always, always. Never, ever, ever, ever do this. And why? To do this, you're like, there's going to be a problem with your manager because they're going to say, I can't read this. You know, people need to look at it from left to right, from 2016 to 2025. Okay, always. Does that make sense? Okay. So how can we switch this, Peter?
PDF or PDF?
A function?
Yeah, type in PDF. That's what it was. Yeah, that's what it was.
It's just got to be a drop down. Let's see.
Go to settings. Display.
Great. This is what we want. Okay.
PDF is forever.
What's that? Oh, okay. So let's now I have a sheet that's been already filled out, so I'm not going to do this with you. What I want you all to do is go through keystrokes, start filling out the document, and then when everyone feels good, just give me a pointer. Like, I don't care if this takes an hour. I really don't. You got to be able to keystroke. You got to be able to data entry. You got to get a chance to look at a screen and put it into an Excel file. It's got to get done. So I want you just to update it. So when we looked at, and I could just quickly go with this with you all. Last fiscal year. So remember we talked about so current, I'm just looking at this quickly. So they haven't had any quarters or anything, so this is kind of good. I'm just trying to think about how to think about current fiscal year and last fiscal year. Because it looks like the months ending, you see where it says 12 months ending? They ended their year on January 30th, 2021. So their current fiscal year is ending when? When is their current fiscal year ending? Exactly. So in April, we are in their 2022 fiscal year. All right. Now, I don't know what they call it, and Macy's probably calls that their fiscal year 2020, even though it ends in 2021. Now, because they're only capturing one more month. Some software companies will capture like June, you know. Now, this is what we talked about holidays and stuff. Why would a retailer use January as an end date?
December, yeah, sales.
Because they want to capture that, right? They want to capture what happened at the end of the year. Because if I give you, it's not a good full picture. If I said, oh, the end of the year ended December, yeah, you have Christmas holidays, but then there's New Year and there's maybe returns and people get money for Christmas and New Year and holidays and they're going to buy stuff on Rosh Hashanah or the whatever the holiday is and Hanukkah. I'm sorry, Hanukkah. People get money. They're going to keep shopping, and this will run into the past end of the year, so it makes sense for them. So let's just start keystrokes. Current fiscal year is technically, I guess, going to be the estimate. So this here for Macy's CFY is going to be, we'll use the estimate of 20.659, right? This will be the current fiscal year. This will be the next fiscal year. This will be the last fiscal year. That makes sense? Last, LTM, current, next. Let's just do it that way. Does that make sense, everybody? Okay. So just start with the general inputs: revenue, gross profit, EBITDA, earnings per share. You have cash from operations. You have it there. You have CapEx, and you have it there. So now the middle, gross profit, operating income, interest expense, just do the LTM numbers. Gross profit. Interest expense, we're going to go somewhere else for that, so we come back to that. And for operating income, for the LTM operating income, let's just make that EBITDA. Make it LTM EBITDA. Oh, no. And you see where it says, see where it says here, this one?
Yeah.
Let's just make this LTM EBITDA. All right? Yeah, yeah, just fill it out twice.
Just make sure we're looking at
Yeah, hold on. I just got to chat here 1 second. Where did my chat function go? Sorry, Zoom, the chat. Can you all? Oh, that was Peter. Okay. Okay. Sorry, Joe. What were you saying?
current year is 22.
Current year is 22.
23. LFI is 21. And LTM will just be LTM total.
Yep. That's it. And the reason why is that if they had, well, because the current fiscal year is always going to be an estimate, right? Because we don't know what they're going to do at the end of the year. So even if this was June or July or August, you would have revisions. This would be a revision. Because this is analyst expectation. Remember when Aaron mentioned that earlier about the changing, and they're gonna revise this in July and August, and September as they get closer to holidays.
Right.
Let's say this. This is. Can we just stop for 1 second? Think about revisions. Let's say 20.6, right? Let's say COVID comes back in a bad way. Vaccines don't work. They shut down everything again. What do you think happens to that expectation? Exactly. We're going to reduce it. So this is what I'm saying. The current fiscal year is always going to be changing. Yeah. We're going to get to interest expense. Yeah. Right now, I just like this page because it's just a short synopsis. We're going to click over to the other one after.
Oh, so the interest expenses are empty?
Yeah. Leave interest expense empty. Leave interest expense empty for now. Which numbers are we using for LFY? Last fiscal year, Robert, we're using the one in 2021 right here, last fiscal year. And Robert, just to reiterate, this ended now because we're in April. So their fiscal year ended their last fiscal year ended on January 30th, 2021. So our next fiscal year, meaning the current fiscal year we're in is 2022, and next one is going to end on 2023. So last fiscal year is right here, current fiscal year is right here, next fiscal year is right here. Is that clear, Robert?
On Excel, and we have EV and enterprise and equity value at the bottom. We want to look at last fiscal year, or we want to look at last 12 months? That's not
specified. You're talking about what, this?
Yeah, those enterprise equity and equity shares.
Yeah, we want the latest, the most recent. And that's a good point. We'll get on that. How are we doing so far? Has everyone got in the basics of what we need, what we can? Only put in what we can see right now. We're going to move on to the interest expense and other things. So very important. You work in finance, you know, speed, accuracy, speed and accuracy. My wife was an accounting major in college, and she said that her accounting professor told her something and it just stuck with her forever. So I started repeating it too. You know, speed and accuracy is most important. And people want you to be able to do things fast and do it correctly. So, you know, that's why I'm saying you got to get used to the keystrokes, you know, doing it and doing it and doing it and doing it and doing it. Make sense, Kelly? You got to practice repetition. You know, you got to work in Excel, work in the documents or the software that you're going to use with your employer. If you're not practicing today for your job, you're just going to start off on the wrong foot. Thankfully, JP Morgan Summer Investment Banking Analyst, you're going to go through a training program. So that's huge. But you still want to be, you know, it's probably going to be what, 2 weeks, I think? Yeah, 2 weeks training. So, you know, I mean, 2 weeks is not going to make you an expert, right? So you like to kind of be a little bit prepared, at least, so you can, you know, just move on a little bit quicker. What was that beep? Yeah.
Why are some things blue and some things black and some things green on the financial model?
In the financial models. So blue means that you input the numbers yourself. You hard coded those numbers. Green typically comes from another sheet. Does that make sense? It's linked somewhere else, another sheet. And black is usually just a calculation. Okay. Yeah, you know, to be honest with you, I know it sounds maybe silly. I almost don't care if you guys put in the wrong numbers. I just want you to practice looking at the data and inputting it. Oh yeah. So let's see. Go to key stuff. What you're doing Best Buy now? Oh yeah.
Cash operation. Operating cash flow.
Okay.
We don't have it, but we want to.
And I was gonna, you just want to see what right now.
Those numbers that.
Oh yeah. So okay, that's a good point. For debt and cash. Sorry, I didn't clarify this, but it's important. For debt and cash, cash, always the latest. You got to know the latest. What is a balance sheet? My accounting major. What is a balance sheet as a, what do they call it? A snapshot in what? It's a snapshot of the most recent time, right? So you want to know the latest. Latest debt, latest cash balance. Does that make sense? Latest debt, latest cash balance. And that's going to come from your LTM. It's the last quarter. The debt on a balance sheet. It says system will perform a shutdown. Okay. Yeah.
in the Excel sheet, anything that on that screen that is negative, then I'll put it like
Oh yeah, if it's negative, we just want the math to work. So if the formula says this minus that, make sure they're both positive. Right? Did you get that? Okay. How are we doing so far? Did everybody finish Macy's? So far, we haven't finished. We got to go find out the interest expense. What's that? Okay. Slow me down. No, I'm just joking. Take your time. I want you, just like I said, it's all about the inputs. Joe, how you doing? Okay. Well, you've had practice. So. Yeah. Technically, you cheated. How you feeling? Feeling okay? Yeah, so this one we just want to do, don't use the negative on that one. Just because you have the formula. Yeah, it's just 330. So it's okay. It's 330. Just use 330. There you go. Yeah, because so the math is this minus that. So for the negative, it's going to give you a bigger number. Yeah. 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 Sorry. 2 days ago. Yeah. Huh? Yeah. I was just saying more than yeah. I have to check every number. Well, gross profit operating numbers. You put an equity on value that was. We don't have equity. We don't have equity. We'll get the other sheets. Equity value on that is okay. So how are we doing so far? And people on Zoom, you know, instead of chatting, you could just chime in with a question, right? Can they hear me? I mean, they can. I can hear them if they start talking, right? Yeah. So if anybody on Zoom wants to unmute and ask a question, or you're unsure about something, please feel free to do so. That's what I'm here for. So, okay. So what weren't we able to fill out so far? What were we missing? Interest expense and diluted shares? Okay. So let's go to the income statement for the interest expense, right? Let's use the net interest expense. What is net interest expense unless there's the last 12 months number? Net interest expense is how much interest do we owe, and then how much income are we gaining from the cash on our balance sheet? Because they invest the cash on the balance sheet in treasury, short-dated treasuries. So let's use 280, round number 280 for the interest expense. So let me just see. Memorize what exactly? You mean the calculations? Yeah, I mean, I think you should know, yes, how it's calculated. Is this, let me just new share for the, if we scroll down, and I'm hesitant for you to be like, this is the exact numbers. And this is how everything should look. But let's just think about this for a second. What are we seeing here right now? This is just Macy's. We're seeing what? EBITDA margins of 14%. But what are we seeing in growth rates? And still, all this is kind of crazy right now. And an EBITDA multiple of 4.5 times. Why does it seem all kind of wacky? It doesn't seem right. Because what did we just go are going through as a world? A pandemic. So if you're in a pandemic, don't you think your growth rates are going to be off, and your revenue growth is going to be off, and your earnings growth is going to be off? Does that make sense? So if you were an investor, how would you want to analyze Macy's or a retailer? You would think about what? Would you almost throw out this year? Yeah.
Pre-pandemic plus the growth in e-commerce and see if what Macy's is doing.
Right.
In order to combat that.
What are the expectations going forward? Right?
Probably I mean.
Yeah, but just to kind of get a sense. Well, how are they looking? What are they guiding for? What are they expecting? Analyst estimates are very much influenced by what the company tells us as a market. They have earnings, and it's a big misnomer. Like, analysts are sitting there creating these models without any input. It's coming from the company, and they're going to kind of stress test that a little bit. Does this make sense? If they're saying they're going to do 20 billion, well, how much? What's their market position like? What are they like relative to their comps? What's the economy doing this year? Is the economy growing? Is it not? Are they discounting? Are they not? Do they have to discount a lot? If I told you that a retailer is expecting margin growth, so margins are going to expand, and then at the same time they told you that they got to discount all their inventory, wouldn't you question that? But if you're going to discount the inventory, you're most likely going to compress your margins. So how are you growing margins? This would just be a question. There could be an answer. They could say, oh, we're going to reduce our operating expenses, so we're going to fire a bunch of people. So yes, our gross margins are going to decline. We're going to sell our products for less money, right? Profit. But then we're going to fire a bunch of people so we can make that up in operating expense, right? But I'm saying these are questions you have to think through in your head. This is being an analyst, right? Analyzing and thinking, okay, what is happening here? What is going on in front of me? And then what do I have to understand? So let's go on to the next one. Was it JWN? Oh, sorry. There you go. Diluted shares. Let's do last 12 months. So 316.6. Diluted shares 316.6. Do we understand basic and diluted? Do we know the difference? Typically, the markets are going to look at that on a diluted basis. Diluted basis is going to include options. If you have, if you have a bunch of employees that have a bunch of options, and then they can exercise those options, those are going to dilute the shareholder. So the market's typically trying to look at it on a diluted share basis. There's also buybacks. Companies buy back their shares. They're going to reduce their share count. It's called financial engineering. I think it's kind of above everybody's here to kind of get into this whole detail on buybacks. But idea is if you take shares out of the market, you're going to increase your earnings per share in a more manipulated fashion. Because remember, it's net income divided by shares outstanding. So, and if our earnings per share is $1, we can increase our earnings per share without any more earnings by just taking more shares out. Is there a question? Oh, no? Okay. Yeah, thank you. You got to keep me honest here. I'm appreciate that. Okay. Let's go to Nordstrom. So we're going to go back here. Key stats. Actually, you know what? Let's go on this page first, and then we'll go back because there's only two inputs we need from here, right? We need interest expense and the weight and the diluted shares. Correct? Okay. So let's look here. Interest expense. We're going to use the net interest expense 280. So 280 for Nordstrom, JWN. Oh, I'm sorry. Sorry about that. Am I frozen here? Okay. All right, we're gonna pull these two numbers for Nordstrom. Nordstrom LTM net interest expense 181. Diluted shares 160.9. Everybody good? 181 interest expense, 160.9 diluted weighted shares outstanding. Now here, you got everyone can take it from here. Same concept, same thing, nothing changes. LTM, got your current fiscal year, next fiscal year, last fiscal year. You have everything you need, I think, from here on out.
So maybe just one thing with Excel, I think my current fiscal year and last fiscal year on that sheet is maybe different than what we're doing today.
Okay, that's okay. That's okay. We're just gonna get a sense of yeah. So yeah, that's fine. No big deal.
It's not even that. Doesn't- that's fine. Oh, Yemen sales. So one from sales and then.
How we doing? Yeah, just gotta change the CapEx. Yeah, I think I mentioned that, but I don't know. Yeah, that CapEx number. So everybody understands that operating cash flow minus CapEx equals free cash flow, right? Remember, CapEx is a money outlay, right? You're spending money. So if your free cash flow is higher than your operating cash, it doesn't make any sense, right? Because our operating cash minus that. So if your number is minus, you gotta make it positive. To get free cash flow, right? Got it? Yeah.
There's one thing.
Perfect. Everybody okay?
Why is that in the creative,
Yeah, because you can just pull it right there, market cap. 5876.9. 6. Joe, you know what you can do after you fill it out? You mind just emailing yourself?
This,
Yep. And then I can use that on the screen.
Yep.
Okay.
all the companies?
I mean, whatever you're filling out right now, when you're done with it. We're gonna go through all of them right now. Don't worry about the shoe companies because like those Crocs and stuff.
What do you want me to email the retail when all the companies are for?
Yeah. No, you're done.
Yeah, we'll do.
All right, everybody good? Zoom? Everybody, we're good? Gonna move on to the next one. What's the next one?
That's fine.
Best Buy? Can I move on or no? You can stop me. Once, twice. Somebody say 1 second. Okay, take your time. I'm with you for the rest of the day, so. What is this going till 10, 11 o'clock tonight? Come on, we're working. Callie's gonna be an investment banker at JP Morgan. She's gotta get used to those kind of hours. 11 o'clock is like, are we eating dinner?
100 hours.
That's it. Are we ready? Are you mentally and physically prepared for this?
Oh, I want, no, I usually speak very early with you.
You do. If I were you, I would just stop eating for the next few days and just to see if you can work without eating anything for days. Straight. No sleep. No, I'm just kidding.
Have you had days like those people in the Golden articles have written about?
Yeah. Yeah. I think from so I you know, I was a banker this summer. So this past summer with COVID, I think I worked June, July, and August. I think I maybe took off 2 days.
Oh, the hours. All day.
Yeah.
Or into like.
I got my nephew a PS5. You want to laugh? You want to know why I got my nephew a PS5? I got my nephew a PlayStation 5, which is very difficult to buy because I was up at 3:30 in the morning working,
So no-
and they did a drop, and I was able to get it.
Nice. This one day.
So my you know, wee midnight hours, 3:30 in the morning, it actually was. I was able to buy him a PlayStation. How funny is that? I was literally like, I'm gonna go to bed, and then I saw it on my phone, and I was just like, oh, good. At least I got a PlayStation out of all this work. I didn't get a PlayStation, but he did. He's 13, so he was excited, obviously.
You're no fun with.
Oh yeah, yeah. No, he's a good guy. I bought him that, and I gave him $1,000 to trade stocks, and he bought DraftKings. So we've owned I mean, I picked it, but it's his account, so he's not allowed to trade. Just pick one stock, and then he's got to do this. So he's like 13. He's creating financial models right now. So you know. So I tell him by the time you're 18, and you know he's gonna go into an investment banking interview at 22 and be like, you know, ready for the MD role. All right, how we doing here? Can we move on to the next name? Yeah. All right. What is the next name? All right. So for the income statement, last 12 months, we're going to use interest expense net. That's weird. Why? Hold on for a second. Let me. Peter, can I drill down into this to see where they're getting this from?
You can click on it and, I don't think the yellow. They should have something there.
52. Yeah, because I don't think it's 9.
Go to are you on the regular IS adjusted?
Yeah.
Just try gap for 1 second and then if you click through, it'll be a little,
Huh. Yeah, you know what? Let's just use 52. I don't know what that is, and I don't, So in Zoom land and in here for Best Buy, interest expense 52. And for diluted shares, 263 spot 2. We good there? Good, 263.2. And for interest expense, 52. And we know what to do here. And market value is equity value. Maybe I should clarify, but I found that earlier. 52, yeah. I don't know where the 9's coming from. It just looks weird. So look, that's something just as being an analyst you need to think about. Don't take every number you see as fact. Why did that happen? Why do we have historical 52, 70, 62, and all of a sudden says 9? Is that right? Is it wrong? I mean, you have to think about it. Don't take everything as when you're working as an analyst or in finance or in accounting or in any job. Always question what's going on around you. If something looks odd to you, you got to figure out why. It could be wrong. It's all human input. Everything is being input by someone. There's someone at Bloomberg. Does Bloomberg do this manually, Peter? Do you know?
They've had errors next to errors.
But they do it manual. So there's somebody typing this in. Okay. So there you go. Look, it could be right. I don't know. We'd have to go look at the filings. It just doesn't make sense to me that is the case. So. Let me know when everybody's done with this page, and we can move on to the next one, and the next one, and the next one. I think it's the Target Walmart. We're at Care. Well, I am going to leave off today a little bit, just on some career discussions. I know not everybody comes back next day, so I just want to kind of just have like a career discussion roundtable today. If you get,
You guys are only
okay. Okay, we can leave for tomorrow then. The worst is like if somebody comes tomorrow. It's just like a waste of time. But I guess they can get the keystrokes. Yeah. Right. How are we doing? Everybody good? You already on Walmart, right?
Airport, Texas.
Who bought a Tesla? You did?
Wow.
What did you get? A Model what?
Model three.
And how is it? You have it?
It's coming in May 27th, I think.
Oh. Excited?
Really good. I took a test drive. The only weird thing is not hearing exhaust.
Yeah.
That's a weird.
What are you driving right now? Oh. So you keeping up the Mustang?
Nope.
You keeping that too? Oh, this guy. What are you doing now? You an investment banker?
Your property still.
Okay.
So I saved up for 6 months after the
You should do what for it?
real estate property.
Oh, you have them? Warren talking about it. Huh?
One boy.
Oh. Cool. Yes, all right, can I move on? Everybody okay? We'll move on? Once, twice, 3 times? All right, I'm moving on. Target next. We're going to go interest expense first. $977. Quite a bit. Diluted shares, 506. Okay. So where do you rent out? You rent out what? Where? Did you buy your mobile home? Did you place them somewhere?
No, so some mobile homes on all different brands.
Ah.
And the one that they on the less than 50, but we can pay higher. Right now, the mortgage is expensive, but rent like it, they use that.
Actually, yeah, mobile home.
Okay, use one maybe like state, and that they use that for the property. So you already build it.
Oh, okay. Yeah.
Ship Holland is on North Park for the moving station.
No.
They raised all of the rents, and so it's not additional fees and expenses enough to go back to so they get most of the things. And then they're going to use those. Another benefit of this is I didn't buy the mobile home because because I did a real estate house like the federal houses on it. The value of the land is the so $150,000, but that's not buying for partners.
Right.
So the next 6 to 7 years, they just to fix like that. But it's just in case of basically, even if you want to buy the land, I know the price, whatever. So
How do you finance that?
it's just 6 options that he gave us the budget, like it's with the numbers to see.
Remember, so you borrow for the land? Buy the land?
No, so the land comes with a mobile home.
Oh, so you're between mortgage and okay, so you
Yeah,
buy
so the mortgage
it's just like a house.
yeah, like basically, but
Right. I never heard that before.
you need
It's
it.
probably not.
I went there first and I was like, so this is the house.
Is it Bayonne?
Yeah, it's in Bayonne. So I'm asking them, they're like, this is sold at the house. I'm like, that's impossible.
Yeah.
And then,
So you have to take off the wheels?
yeah, they take out the wheels and it's crazy.
Yeah, because I'll say it's, yeah.
But then I was looking at other places which actually
that style. They try to sell small homes, they remove homes,
Right.
but instead comes as houses. That's what they did if they own, but I think roughly there's like 4 acres of land, and that's right by the coastline. Basically, they build an apartment, go way up to $70 million. That's the property value for that apartment. If they build an apartment.
Wow, that's awesome, man. I know when you got a Tesla and a green Mustang. How are you doing, Kelly? What color did you get the electric blue one? How did I know?
And that was the one that was dealing service, because it's electric. So you keep on blue electricity.
Yeah. Cool. All right. Can we move on to Walmart, or should we still stay here longer? Yeah? All right. What's that? One more? Okay. Take your time. Take your time. How is the financial planning still popular here? What about the sales?
We work on it too.
Really?
And two grand is good. And
What's
tomorrow
that?
will be hard.
The sales?
I'm part of it.
The sales?
Yeah.
Yeah. That was very like the competition and stuff.
Yeah.
This year, the competition.
Alright.
So we had a period where we didn't have a period. They had to do since COVID.
Good, good. Everybody feels good about what we're doing? I'm gonna come and check everyone's performance. It's all good, okay. So we're gonna do Walmart last. Interest expense, let's just use this, 1855. 1855. So that's 1,855,000,000, right? And how do we know that? How do I know that this is 1,855,000,000? How do I know it's not 1 million or 1 trillion? Always remember, if you're formatting an Excel spreadsheet or you're reading information from a filing or companies providing financials, make sure to know this. What are you looking at? Some will show thousands, some will show hundreds. So you got to know what you're looking at. Is it 1.8 million? Is it 1.8 billion? Right? Make sense? Okay. So let's use the 1855 for interest expense. 1855 for interest expense. 1,855,000,000. And for weighted shares, 2826. 2826. And we're gonna do this. Stats. All right. You have this information now. And the equity value you have, free cash flow, no operating minus the CapEx. Don't use the minus there, you got to change the sign to positive. Perfect.
Planning. No, that's
Yes.
I have worked in that, which is good. Did a good picture of it. we're gonna write the business analysis. What is where it's going to use? You need investments or, we try to do all the analysis. So trying to create a framework that we get companies, so the originally the jobs for the fields. They're like, they want to fill out, but there are tests and the ranking system. So they can fill things out manually and form, and this is us, the investment. So kind of what's that, how's the score, what's going on? So we can look at this, is automatic, so the technical. So they're creating software to pull all this data into. They're creating data analysis, the sets. Actually, the ranking for each number, because how do you rank each job? Like, is that, so it was interesting, because I was on the call, because they want the investment to be a part of it. It was just good, like, so, the ranking is one factor of these, well, that's the dollar. That is how. Like, how does it tell you? And really put that sense of our margin, do that margin. And then one of that one person. 10% margin from one industry would be bad, but 10% margin different is good. So this are things that are thinking. Yeah, exactly. So they're thinking this stuff through and trying to build out a framework where this whole being kind of file, but spit out something that we can quickly so that we know that actually has the ability. It's not kind of like what percentage of yeah, right, of course, yeah. So we're just trying to do that. And then we have he's not doing this, but business. Our business must be doing it all. So, when we do the business. Yeah.
Yeah, this has to add separate. Yeah, because of all that stuff.
Yeah.
It's really comes to this. I'd say it's really good.
It's generating needs or like, well, no, or it's just, yeah, keep track. Yeah, or data sales. I don't even know if I do this. That's amazing to think that Salesforce has software for crazy job.
Because I added configuration to 6606. Yeah,
Right.
that's made it.
Or, investment. We're using something for all of you, and all of you can say, focus on the debt markets, and create a software to keep track of your contact, where are we in our underwriting process, and then just to control to Excel, and then it goes over all through, so you can see like what the rating is. So there's 5 and 6 or stuff all the time. And this kind of all this data gets pulled into the software, and then it's a whole part of that 300 great risk portfolio or how much concentration is there.
6 billion.
So I sort of think that this is on itself, right? It's so but right, it just they don't have to go into it. It's doing it. Yeah. They need to support it. Our false skip a week is the way we are right now. What's risky, what's not, yeah. So I just added the 600. I know, that's a lot of it is. All right, how we doing? We done? Everybody good? Can we start to analyze the data? Because this is just the input, right? We good? Can we start analyzing the data? Understanding it? Joe?
Yeah, I should have just.
Alright. This is really big for Joe right now. Why is this big for Joe? What is really why is this a big moment in his life? So no, hold on. I don't see it. Oh, sorry. So okay. All right. So why is this important for Joe? Here's why. In the real world, in a job, is this it, Joe?
Yeah.
Okay. You're going to send your boss a document like this with no one checking the work. Okay. Expectation is super important. That's right. The expectation is you did the work correctly. No one will check the numbers. Somebody might spot check a few, but nobody wants to find any mistakes. So always have to remember to be right. Double check, triple check. Don't worry about speed as much as. So I know I said speed and accuracy, but I think the accuracy part is more important. Speed is also important. We got to be accurate. All right. So let's just start to think about this a little bit. Now, what did we do? We took all this information and we put it into a spreadsheet. And just looking at this, let's scroll down here and let's start to look at this. And let's start to think about now this here. Editing. Am I sharing with okay, let me just. Okay. This here is, I should just fix this. I just LTM margins. LTM margins. That's important because we just want to make sure what are our LTM margins. Or you know what? I'm sorry. Let's not do that. Apologies. LTM here. So I should tell you also shortcuts. Okay. Down, shift, space, control, shift, plus. It's quick, but that helps you move down a row pretty quickly. Okay. Let's also do CFY EBITDA margins. So tell me, give me what's a CFY EBITDA? How are we gonna calculate that? CFY EBITDA margin. What do we do? CFY. What's that?
Take the CFI EBITDA.
Right. How do we get a margin? Over of what year?
Correct.
No.
Last year.
CFY. Apples to apples. We got to make sure everything's on the same basis. CFY EBITDA over CFY sales. NFY EBITDA or because what is next year's EBITDA compared to last year's sales, tell me? Nothing. No. Next year's, if I told you that next year I'm gonna do 10 million of EBITDA, and last year I did 20 million in sales, you can't say your margins are 50%, right? Because what am I going to do in sales next year? You need that answer. Make sense? So let's just do that. Okay. Did everybody just do that or no? We're gonna do one more thing. See here? We want to just move this. Just put your mouse here. View. freeze. Okay, see now, this is how you should always have it set, okay? Okay, so let's start analyzing it. What do people see here? Like just start talking. Kind of what you think, thoughts. Right, thoughts. What are we thinking about? We got Macy's, we got Nordstrom, Best Buy, Target, Walmart. I mean, like, what are you seeing here? What are the numbers telling you? Anybody?
Last 12 months, you get it, and Macy's, almost nothing.
Right, and then what's the expectation for this year? Percent margin, right? So they almost had a loss, right? They pretty much weren't profitable. But next year the expectations are better. So if you were to, let's forget about multiples and things like that, just on a margin basis, what company seems more attractive to you? What looks like the most attractive business out of this business? Without knowing anything else. Again, let's just say it's gross. How about this? Let's look at gross profit. Let's look at EBITDA. And let's look at CapEx too. This is your cost, right? CapEx, CFY EBITDA, because remember COVID kind of ruined our last 12 months, and gross profit, which is last 12 months, so it could be off, but let's just use that for now. Which one seems more attractive? I mean, I don't think anybody really, I don't know if you're going to be wrong, you know, I mean, it's just like, what do you think? What are your thoughts? Joe, what do you think? Which one's most attractive? And why? I need to know why.
Macy's the most attractive because their gross profit margin.
Okay, Macy's does have the highest gross profit margin. That's true.
Their CapEx is the median of the pack.
Mm-hmm. Doesn't seem like they're overspending or underspending. Probably spending the right amount. They have the highest gross profit margin. What about EBITDA margins for next year? Or this year? The CFY numbers. Yeah, I mean, they got 7.27%. I mean, last year was a bad year. Like I said, I wouldn't really focus on the last call. But this year, we're doing pretty well, right? So, it seems relative to the rest of you. The rest of them is pretty attractive. I mean, what are your thoughts on any of these? Macy's? Is there someone else that looks more attractive to you? Anyone that you wouldn't make an investment in? We're not taking growth into account. Growth is a big factor in this, but which, you know, just to think, like I said, just talking. I don't think there's a right or wrong answer here, by the way. I mean, I'm kind of surprised, to be honest with you, that Macy's has the highest gross profit margins, but there's probably reasons why, you know. But what's that?
Target.
And why do you like Target?
No, I said I would not.
Oh, you would not. Why? Out of this group, if you had to pick one.
They spend a little bit more on and also the expenses a little bit higher.
The capital expenditures, right? So they're spending a little more, but they're getting more, right? On a margin basis, they are getting 9% on a margin basis relative to. So they're spending a little bit more, but they're a little bit more profitable. You know. What were you gonna say?
I guess I was just targeting what you just said. They bring more so that they can get back more rather than lose.
Right. Okay, because they've already built out this. Right. They've built out this infrastructure.
And especially, I know when you look at these Target also focus more for e-commerce. That's what they put into the money.
Exactly. Right. So they're spending more in e-commerce, which should generate you what more in the future.
more profit.
Right, and they're getting it, right? So like, look, this is where kind of this game gets played. It could be an allocation issue. So allocation means how are we allocating costs, right? Accounting, you understand that. We have COGS and we have EBITDA. When everything is falling down to profit, we're more profitable here with Target, right? Than we are Macy's. And yeah, we're spending a little bit more, but we're more profitable. And as he said, very intelligently, they're most likely spending a lot more in e-commerce, online. So we're going to spend that money. That's hopefully once that's set up, we can become a lot more profitable in the future.
And they don't have to spend as much EBITDA in the future because that's the initial investment.
In spending CapEx
Yeah, CapEx.
to get EBITDA. Right. I don't know the answer, right? I'm not a great Yeah, we're just speculating. But the idea is to think about these things. Any thoughts, Peter, on all that? What they said?
No, I like it. I'm surprised that, I guess you're not surprised that BBY is below CapEx, because the stores don't change for the most part.
Yeah.
Nordstrom is constantly redoing it.
Yeah. This is surprising. I mean, just so you all know, like Nordstrom's been a pretty poor run business. And there's a lot more that's behind that. It's run by Nordstrom family. They're a very wealthy family. They're still the largest shareholder. Typically, there's shareholder stock investors sometimes don't like that. They're old into this mature business. They kind of run it like their little baby kind of thing. And maybe they're not doing the best things for shareholders because they're very rich people. They're probably billionaires for sure, right? The Nordstrom family. I mean, they probably own a ton of real estate. But I personally like the Target story because we know now BBY, that's good. Let's think about that for a second. What is BBY's business? Right. So why would it make sense that their gross profit is lower? Why would it make sense that a person that sells computers, well, and again, I don't know the profitability, so it's kind of difficult, but let's just say a t-shirt versus a computer, a monitor. Like, what do you think the margin on this is versus this?
More expensive to build a computer. T-shirts are free.
Like, let's think about Gucci. Gucci's perfect. Gucci makes a t-shirt. What does Gucci sell a t-shirt for? He said 100. So you said, what? 100? You want this guy's buying Teslas and mobile homes. He wants 8 Gucci shirts for $100. I can tell you that. Yeah, they're doing like 350. How much do you think they make that shirt for? $6. I mean, it's lower than that. Right. Can they ever sell a monitor? I mean, of course they can't sell a $10,000 monitor. Who's gonna buy them? You want, there's gonna be kind of a stuck margin on this, most likely, right? Some manufacturer is making it, and then Best Buy's gotta buy it from them and resell it. The point is, the profit margin should be higher on a t-shirt. I think. I don't know. I don't know if this is the answer. I'm just saying these are sort of the things that you're gonna kind of try to think through. And they're selling hard electronics, like we talked about. They're reselling. How much can they make on a profit on an iPhone? Right? Because they got to buy that iPhone from Apple, and then they got to resell it in their store. How much can they make? Right?
Well, maybe they're making commission, or they get it at a reduced price. They can do that, but they still have to.
Yeah, so that's smart. They're going to get a reduced price, of course. Apple, look, if you, and again, just basic business. If you and I have one store and we sell cell phones, we called up Tim Cook and he actually picked up the phone. But I don't think we're going to get much on discount, right? How many phones do you want? I don't know, 10, But now we're Best Buy. We have 1,000 stores. Well, how many? We need, 1 million phones. Yeah, exactly. That's called leverage, right? That's a little buyer leverage, right? You're going to be buying it from the supplier, and they're going to give you a little bit more of a discount.
If you look at it, Best Buy is able to give you discount and offer products when they have sales and stuff like that.
Right.
On the other hand, it's not going to give you any discount, anything on their product.
Right. And then from a supplier perspective, if you were making a monitor, maybe, if you and I had a startup monitor business, we'd probably want to give them a little bit of pricing, right? Because you want to try to get them. And then what do they start to do? They start to promote your product a little bit more. Why? Because they're going to be a little bit more profitable, right, on those products. So maybe they're going to start to push your product in the store, right? Again, this is all just conversation. Now let's talk about growth rates here. CFY over LFY, meaning this year versus last year. Who's looking for the most growth? Nordstrom, 24%.
I don't know. Okay.
Well, but no, he's right. 24. It is Nordstrom. The growth is highest in Nordstrom. But what does this tell you here? The minus. This kind of tells you that they had a good 2020, right? What does this tell you? This tells you that they probably had a pretty bad 2020 because no retailer is going to grow 25% revenue, right? Because like it's not, it's not Tesla. Tesla can sell the Model S and the Model X, and then the second that they let up a 3 or a Y, you're going to see sales should start to spike, right? Yeah, plus it's a new product. I mean, has Macy's changed in 10 years, 20 years? I mean, you go to Macy's, I think everybody knows what you get Macy's. You're only going to get Nordstrom, right? So it kind of does that. But now what about, let's go another one. Let's go to the current year. So now things have gotten more normal, and next year. So remember we liked Macy's originally, right? Just looking at the margin profile, we like Macy's. But now, what do we see for growth for Macy's? It's very low. What is that telling you? There's no growth in Macy's, right? So now is Macy's an interesting investment to you? There's no growth in the business. Again, look, this isn't a right or wrong answer. There's value investors, there's growth investors, there's all kinds of investors. There are some cheap stocks that are good to buy. This is all just to kind of get you thinking. That's all the purpose of this.
Would it also be that we don't really know, these are next fiscal year or estimated ones.
Of
so
course.
You don't really know how it's gonna be, but based on what's given, you just assume that it's not a much area for growth, so it's pretty stable.
Right, yeah. I could bet, the analysts are typically always going to be a little bit over bullish, I would say, just in generally when they model things out. There's relationships with companies that they have, relationships with management. If you're a JP Morgan analyst, maybe you don't want to, show too much negative growth, even if you really believe that. So, and even the next fiscal year, you're seeing 5% growth from revenue from Nordstrom expectation. Now, these two things could be tied together, right? The CapEx and the growth in revenue. Why would that happen? That could be something that we're talking about. Maybe Nordstrom is investing more in e-commerce. Maybe they're going to be driving more people online. Maybe the analysts see some spending that the company's doing from a capital expenditure basis to build something out that would be then driving revenue, right? Okay. And then the rest are kind of pretty small. We have our earnings. Now, let's just do this. Let's scroll down here. Right here. Let's do EV to CFY EBITDA. And here, we just want to do the enterprise value currently divided by this, CFY EBITDA. Okay. So what do we see here? Now, let's start talking multiples now. What are you seeing here? Who's the most expensive on a multiple basis? Which one is the market willing to pay a little bit more for? The most. Walmart. Right, at the highest number. All right, which one is the lowest? 7.78. So, what do you think? Why is that? Why is one low? Why is one high? What is implied in a multiple? What did we talk about? Growth, risk, profitability. So, what do you think? Why is somebody paying 13 times for Walmart and they're paying 7.7 for Macy's? Because look, we saw that Macy's had the highest gross profit margins. We saw Macy's has actually 7.78% on an EBITDA margin basis. Why would somebody pay for Walmart? What do you know about Walmart that you think you're going to pay up for Walmart?
Well, we want to get better deals in Walmart.
To get better deals in Walmart. Okay.
It's also an e-commerce store now.
It's also an e-commerce store now. Okay.
They deliver to you, just like Amazon.
They deliver like Amazon. They're a competitor to Amazon, right?
And they're willing to pay much more for their assets that they own So since, as you said, being a competitor to Amazon, they're willing to pay the money as Amazon is willing to.
Right.
To increase their business. So that's why I think I saw from the video, because when I was talking, it's like numerators, like what are you willing to pay for your asset? If that number is high, that means what they're willing to pay for their asset is much higher compared to other companies.
The investors, yeah, exactly. And then, what about just the, no, like, how about grocery, right? So there's a lot more, put it this way, do you see a world where Walmart doesn't exist 10 years from now? Does not exist. You said no, Alex?
Well,
You said no, right? Like most likely no. Yeah, all right, let's say there's a higher probability that Walmart's around in 10 years. Do you see a world where Macy's does not exist in 10 years?
yes,
Exactly.
they already showed it to us when they closed down the retail store. So they're saying that they don't care.
Right. But also just the Macy's business model, right? Department store, it's big. I mean, like just a show of hands, how many people have been to a Walmart in the past 3 years? Almost. Okay, yes. How many people have been into a Macy's and bought something in the past 3 years? One? Yeah? No? But typically, I think the average consumer is going to be a lot more likely to travel to a Walmart than they are going to be at Macy's, right? And yeah, everybody buys on Amazon, and Walmart's the competitor now. So that's just the general sense of it. You know, Walmart's a better business. I think we know that. And then risk. This has got a little, you know, messed up because of that. Let's do the same thing on a forward basis. Let's just do net debt to a CFY EBITDA. So I think I did the wrong one there. This is good. This tells us a good story here. So, oh, I'm sorry. One more thing I want to do. Let's do. Let's just. You see this number here, the cash interest. Let's do CFY EBITDA, so forward, divided by whatever our interest expense is this year. Let's just make the assumption that it's going to be flat going forward. But typically, you'd want to do this on a forward basis, right? Remember we said apples to apples? Oh, there it is. Just so we can get a better sense. Okay. So now we put together operating statistics, right? We looked at margins. We like Macy's, generally we like Macy's, right? Let's just say. And then we looked at growth. And which one did we like the most for growth? We liked, I don't remember. Which one we like? Nordstrom. Now let's look at risk. So see, looking at things on their own, profitability, growth, we like two different companies now. How about risk? Let me just hide this because this is going to confuse you guys. Which one now which one's the riskiest? Which one's the least risky? And how has this changed your thought process, if it has, or if it hasn't? What was that?
Target and Walmart are the least risky.
So Target and Walmart are the least risky. Okay. What's that? On
The individual that's willing to, like the risk factor as to how much risk you're willing to take. I mean, you can say which one is less risky or more risky by
Right.
looking at the numbers. But you also have to look at the comfort zone as to how risky are you willing to go, or risk averse.
Right.
And saying that, okay, if my risk, I'm willing to take up to, let's say, 4 times the risk. I could even go for Best Buy, I mean, not Best Buy. Best Buy says negative, so that means they're not taking as much risk now.
Right there, they don't, well, they have more cash to get most likely.
Yeah, so
Right,
they,
yeah.
so, but if that's something to feel confident, people just take Best Buy because that doesn't have any risk at all because they decided they have more cash. But if for individual says, I'm fine with having 5 times the risk because I know the company will do better in the long term, you could even do any of the companies that's there, like Macy's or Nordstrom.
And then what about just the general, having too much cash? What company's got too much cash? You think that's good or bad? And why do you think that?
Because cash also means inventory, because if you have too much inventory lying behind, you have to sort of spend price.
Well, think about it like cash is like, what are they doing with their money, right? Are they reinvesting it in their business? Are they using it to grow? It's just sitting on the balance sheet. It's leftover cash. And what does cash get you? Come on, you're like Indian Warren Buffett, man. Like the Indian Warren Buffett. Cash, you don't want a bunch of cash in your balance sheet, in your bank account. What's that gonna do for you right now? You're like, I gotta go buy some mobile homes, bail. The cash, you can make money off the cash, right? The point. You don't want just to sit there and say, now when times are a little bit scary and COVID hits, it's nice to have a nice cash balance in the bank. This is again not defining terms, it's just something to think about, that's all. But looking at this, we thought about Macy's. Macy's got the lowest multiple because look, the debt that they're carrying relative to their EBITDA is the highest, right? And what's their free cash flow to debt? 3%. So they're generating very little cash flow relative to the debt that they have. And look what Target and Walmart are doing, 50% cash flow to debt. And their net debt is very low, and they have many, many years of interest coverage. So to Aaron's point, they're probably the least risky from a debt perspective. And when you put all these things together, this is the point of it. You're kind of putting profitability, risk, growth, There's other ways to look at risk. I just try to put it in simple terms so we can understand. This is how you should think about multiples. Does this help put all this together? That's the point of it. One way we looked at it, we said, oh, this is a better company. Then we look at this, oh no, this is a better company. We look at, oh no, maybe that's a better company. So in the end, you're going to make an investment decision. It doesn't necessarily mean, oh, Macy's is better than Nordstrom or Walmart is better. It's all based on price, where we are in the cycle. There's a lot that can go into it. But just generally, this is just conceptually, I want you to get to think about this. And why is a multiple a multiple? Why is the market paying 13 times forward for Walmart and 7 times forward for Macy's? Why? And we can even go one more period. Let's see here. That's the same trends, Also, you see this? EBITDA, trailing 12, forward, 2 years out. Why would this be declining? Think about the math for a second, and then think about why that would be. All right, because
forecasting, right?
right, and the numerator is staying the same, right? Enterprise value is not changing. But what is this implying to you? If I told you that a company is going to go from 12, so numerator is flat, denominator is variable, right? Changes. Why would a multiple go from high to low? What does that mean? What's happening in the denominator? High to low. 10 times to 5 times. What does that mean? 10 to 5 times. What's happening to EBITDA? It's going where? Increasing, right? This is good. If I told you the inverse, let's say I told you that this is a 5 times multiple business, that the market is implying 10. What is the market implying? EBITDA is going to Exactly, because now that's widening that gap. There's an opportunity there, because if you see that happening, this is not investment advice, but if you see that happening, and let's say you think the market's wrong, right? You know, EBITDA is not going to decline, so go up. You can invest in that company and probably make a lot of money for yourself, right? You can say, oh no, I think the market's wrong on this. So, all right, good. That was a pretty good session. Does anybody have any questions right now? We're going to take a, it's 2:25. We're going to take a 10 minutes.